Welcome, everybody. This is the Ask Origin webinar. I'm Michael Episcope, co-CEO, and I'm live with my partner, David Scherer, also co-CEO. And while we both live in Chicago, and that's where I am right now, Dave is actually in the warm air of Florida, calling in from what I'll call his mobile office. Dave, that's a well-timed trip considering it's about 20 degrees here in Chicago. How's the weather?
Well, as you can see, I'm in a t-shirt and celebrating World Cup, by the way. This is a Bayern jersey, so not quite World Cup, but yeah, we travel a lot at Origin, and this is live, obviously, so you see that. It's very important for us to communicate and update our investment partners, but we also have a business to run.
Well, I hope you're parked and not driving, so let's keep the eyes on the phone. To our audience, this webinar, it's dedicated solely to answering your questions. And one of the differentiators of Origin has always been the connection between us, between David and me and our investment partners. And we don't want to ever lose that. And so this is a scalable way as we grow to continue to have that connection with you all. We have a great IR team, and we also know that people sometimes want to hear from us directly. Thank you for your questions in advance. We are going to get to those. And if you have more questions, which we assume you will have during this webinar, please put those into the Q&A box and not the chat box. Only the Q&A box will be answering those live as well. So let's jump in. And Dave, I'm going to start with one question for you right now. What happened with the 549 West Randolph deal? There's been, that's a Fund 3 asset.
Yeah, of course. We had about 100 questions emailed in. This was one of them. We're committed to transparency, so we'll answer the hard question first. 549 Randolph, in the most recent update, if you're a Fund 3 investor, we wrote down that asset, that equity, significantly. And the reason for that is a couple things. One, COVID really hurt office demand, in particular in Chicago, much more so than in some of the southern and western markets. And then secondly, coming out of COVID, the virtualization of the workforce, we believe is permanently going to hurt office demand. We're already seeing it. I'm sure you're seeing it too. And then probably the third reason is just borrowing rates. Borrowing rates in office have gone from 3 to 5% to 7 to 9%. And so these are all exogenous shocks that we had to deal with. In my opinion, most of the office buildings in Chicago are in some form of distress. And so, we were no different there. The other thing I would say is a couple things. One, this is an asset we purchased in 2017 when we were still purchasing office. We haven't bought an office building since, so we've moved away and we're solely focused and have been for the last 5 years on multifamily. And when you think about Fund 3, that's a fund that's going to do quite well. That's why you invest in a fund, not an asset. Some of our other assets did 3x or 4x on equity. And so in a vacuum, this was a disappointing outcome, but as a fund, the fund actually performed as we had hoped. And if you bifurcate the multifamily returns and the office returns from Fund 3, you'll start to understand why we focus solely on multi now. It's just a higher return consistently and a lower risk set. That's why we're there completely now. Although I will say, as a vintage, Fund 3 is a top quartile fund, even when competing with multifamily as a fund. And we were a mixed fund of both multifamily and office. We gave a full accounting in our Q3 report. But if you have questions, and Michael, I'm not sure of the investment partner who asked the question. I don't know if do the questions when they come in, does it include who sent it? It must.
So.
Nonetheless, you can reach out to Michael and I direct, and we can talk more about it if you have further questions.
Next question. When is the right time to invest in Origin funds? Does it depend on the market, or is any time okay? We are not market timers. I would tell you that it's no different than investing in the stock market. Certainly when you look back in hindsight, you can say which times were better than most. our opinion that today the credit markets is where the greatest opportunities lie. That's where we've seen the most dislocation in our case series fund, the multifamily credit fund one, and then in a lot of private preferred equity also within the income plus fund. And what we're starting to see, because of the rapid rise in interest rates, is a huge need for gap equity. Lenders have been pulling back. They've been reducing proceeds from 65, even 70%, all the way down to 60 and 55%. And that's, for new deals getting off the ground, there's a need to fill that gap. And so that's where the income plus fund fills in. And also, on projects that were in the process of refinancing, ground up developments that were just delivered to the market as well. In some cases, they're not even able to cover the loan balance, the senior loan balance, especially if they were higher levered. So we're seeing incredible opportunities to come in at lower LTVs in those investments, and at much higher rates than what we saw 6, even 12 months ago. So it's actually more exciting today than it was a year ago, because it's the whole pendulum has shifted where risk is finally getting rewarded. So, the answer to that is you should always have exposure to real estate in your portfolio. If I'm looking at where the opportunities are, I would say multifamily credit fund and income plus fund right now, and that could shift considerably in the future. Dave, next question I'll give to you, since you can't read them on your phone right now. I'll be the moderator here. Are rent concessions negating rent increases? Is this a sign of budding oversupply?
So the short answer is no, they're not. Concessions, from a cash flow standpoint, when they happen, they can mitigate rent increases in short-term cash flow, but they don't show up in long-term capitalization of assets. That's not how assets are underwritten. But just broadly, it's market by market and even sub-market by sub-market. There aren't a tremendous amount of concessions in the market right now. Let me just transition and change the question a little bit to what we are seeing, because I think that's probably what this question is more about. We're seeing that rents aren't going up as quickly as they were in Q1 and Q2. They're more normalized. A normalized rent growth in multifamily is 2 to 3% a year. Obviously, we're in inflation right now. It's a different environment. So for the first 2 quarters of this year, it was still going up at 3-4% a quarter. So incidentally, I'll cover this in a second, that's what our machine learning was predicting. It's been incredibly predictive over the last 2 years, which is quite extraordinary given how volatile it's been. But what we're seeing now is normalization of rent growth. I will tell you that our own machine learning is predicting negative rent growth in 2023. It's been very accurate to date, but then strong rent growth in 2024, 2025, 2026. So I don't say that from an alarmist standpoint. I'm just telling you that if you think about it intuitively, if historical rent growth has been 3% generally, obviously certain markets higher, certain lower, and we were 12, 15% for 2 years, there should be some reversion to the mean unless incomes are keeping up. And incomes have gone up, but I don't believe they've gone up at the same slope. So, these are the types of things that we spend a lot of time on. And so, like, for example, we get this question a lot. I'll keep going, Michael. Hey, I just saw in the Wall Street Journal that rent growth is slowing. And so, that article came out a couple months ago. And, the reality is, at Origin, we've been underwriting 0 rent growth in Q3 and Q4 and negative next year, and all the underwriting decisions we've made for the last year. So Wall Street Journal is publishing an article about why they think rents aren't going to grow at 8%, they'll grow at 4%. A lot of our competitors and the predictive software you can license, they're predicting pretty strong rent growth next year. We don't think that's true. And the deals that we're doing and the decisions that we're making both operationally, hold sell analysis, new acquisitions are all based on a very different view of the world. In other words, you'll make your return here even if rents go negative. Like that's what we're underwriting. But we also believe in the long-term fundamentals of multifamily, and our machine learning backs that up too, meaning there could be short-term supply, there could be recession, all of these things could happen. But the reality is we're undersupplied in housing, and the long-term fundamentals, it's a necessity item, are still there. Nothing's changed.
Next question. I would be curious which public REITs you bought in the Income Plus Fund and why. So for those of you who maybe aren't invested in the Income Plus Fund, that's a multi-strategy fund where we build, buy, and lend. So it's all of our strategies combined into a single fund. And we have the ability to invest in securities in that fund as well. And there was a moment in time in the last kind of few weeks where we viewed the best opportunity in the marketplace as we're looking at it today was actually in public REITs. And we were looking at the valuations, and they were trading at 2019 levels. And if you kind of understand, I mean, what a public REIT is, it's an amalgamation of the assets underneath it. And if you can value those, you can accurately value public REITs. Well, public REITs, because of the move in interest rates, were just oversold by a large margin, in our opinion. Right? Market can always move farther, but the value of the collateral or the value of the underlying assets had grown by 50%, 60, 80% since 2019, and yet you had the same price in the public market. And we just saw that as a mispricing and an opportunity. And we ended up allocating 5% of the fund's equity towards the public REIT sector, all in the multifamily sector, and some big names: Equity Residential, Mid-America Apartment Communities, Camden Property Trust. And what we look for in those, there's not a lot of pure multifamily plays, and we over allocated to the ones that are in our markets where their set of properties overlaps ours, because we really understand that data set better than others. So something like Camden and Mid-America were over allocated within that 5% bucket, because that's where we see the greatest opportunity in those. And it's actually turned out really, really well for the last few weeks. So it was a very timely purchase, and it's kind of what we're looking for when we're evaluating which opportunities. That fund is agile. We can do preferred equity, we can buy, we can build, we can buy public securities. And that was the moment in time that we saw to allocate capital to the highest risk-adjusted opportunity, in our opinion. Next question, Dave. The outlook for capital calls in Growth Fund 4. Are they likely to be delayed given current market conditions?
Yeah, before I answer that, the public REITs, some it'd be easier just ticker wise. CPT, ESS, AVB, Avalon Bay, UDR, CPT, MAA. And if you think about why we would buy a public REIT versus a private asset, it's because the cap rates are much higher implicit in public REITs than anything we can do in the private side right now. That's what we do at the end of the day. And by the way, it inverts. Last year, public REITs were probably overvalued, and their implicit cap rates were lower. That you could do much better in the private side. And so as an investor, you should know that because we see it all in multifamily, we see all of credit plays, equity plays, development plays, value add plays, private plays, public plays. We have a really rich data set to choose from. It doesn't mean that the public stocks we bought will work. It does mean that they were a much better purchase than anything you do in the private side at a moment in time. That is what's important. In terms of Growth Fund 4, the capital call schedule, it remains on target, but these are ranges. And I will tell you that based on the credit markets becoming more difficult to borrow in the last 2 to 3 months, it's becoming more difficult to get financing to get the projects done. Not impossible. We're an experienced developer. We've chosen the highest margin deals. We're still positive about the deals, but if I have to set forward guidance, I would say there's a higher probability that we'll be delayed than that we wouldn't be delayed. And so I would assign a 1 to 3 month sort of tail to the delay side on all deals not already begun. And that's just based on what I'm seeing in the credit markets. I would also say that in the last 2 to 4 weeks, the markets have improved. And so this is specifically, we want to talk about multifamily credit. There was an auction yesterday, and for the first time, spreads didn't go out. They came in, it was oversubscribed. That hasn't happened for a couple months. And then even on the risk-free rate side, we hedge a lot of our rates, but they were the risk-free rate. When I say risk-free rate, I mean 10-year note yield. It got as high as 4.3. That wasn't so long ago. Today it's 3.6. So it's just a really volatile time, and it's very, very much driven by the Federal Reserve and what they're saying. Right now it feels like everything's trending lower. The yield curve's very inverted, which implies a recession almost always, and a normalization of long-term rates. That doesn't mean that's what's going to happen, but when you've got the 2-year note at 4.4 and the 10-year at 3.6, that's a pretty big inversion, right? Usually you get paid more to take more duration risk, not the inverse.
Yeah, and the second thing I'll say about that is our pipeline has shrunk considerably, and you can imagine the ability to get through deals through when your cap rates have gone from 3 3/4 to 4.5, 4 3/4. You pick it right now, and so the margin on new deals has to be significantly higher than where it was a year ago in Growth Fund 4. So a lot of our deals killed. We pulled them out of the pipeline and shrank quite a bit. So that's one of the reasons when you're talking about current market conditions. It should also be known, though, that we created a very friendly investor structure there, that if we stopped calling capital today, I understand you have a contingent liability, and that's always something that you as an investor have to manage. But if we saw market conditions change to the point where we didn't want to invest any more money, you're not paying a committed capital fee. You only pay on the capital that you're investing in that fund. And that's something that we always have to evaluate. But we created that for investors for this exact reason, that if we don't see any more good deals and we don't want to invest the capital, we don't want to be forced to do so in those situations. Next question.
Michael, let me just add to that, because that's a really good point. As an investor, if I heard that, I would say, well, yeah, but it creates this conflict of interest because you're paid to do a deal, and maybe you'd be incented to do a deal in that structure. But that's where alignment comes in, right? So like all of this goes away and is mitigated by alignment. Like, first of all, Michael and I wouldn't do that, period. And we have a really long track record to back that up. But even if we wanted to do that, we're so heavily invested in the fund ourselves. That's what alignment means. Why would we want to do a deal that doesn't have a high margin? I think we're more equity than almost everyone in the fund. So that's the beauty of Origin, is any question you have, go back to this notion of alignment, and it'll provide that answer. Like, we have 80 million of our own capital in these funds.
Yeah. What is current Origin thinking about Congress reinstating the 15% step up for 2022 QOF investments? Dave, do you want to take that, or you want me to handle it?
I think you're more in the know.
Yeah. Okay. So my expert who I lean on is Ashley Tyson. He's been we've actually interviewed him here before on Origin Investments, somebody who I've known for quite a long time. And the word is on the street that Congress, now that the elections are behind us, is that this isn't a matter of if, but when. And the last I heard, there was about a, kind of a 30% chance that this was going to get done by the end of the year. So very low. And I've heard it's, kind of 75% chance that it's going to get done by sort of the first 4 months of next year. This would be fantastic for those of you who don't know what I'm talking about now and aren't in QOZ. The 15% step up in basis is something that when you invest capital gains into our QOZ fund, if you invest $1 million, what it means that is when you recognize those gains in 2026 and pay them in 2027, that those will be reduced by 15%. So you only recognize $850,000. It's a great piece of the program. The bigger piece is the forgiveness after 10 years than that, but it would be great to see this back, because I know that step up went from 15 down to 10, down to 0 where it is today. But at Congress I'm still really pleased with how the program has been going. It's got a lot of bipartisan support. I think there's some people who have kind of fallen off on the fringes, but last I heard, it's got 75–80% support of Congress right now. Next question, Dave. Can you please outline the difference between growth versus income fund and how to select one over the other?
It's a choice, So when you say income, do you mean income plus, Michael, or?
It can be you, however you want to define it, Dave. All of our funds.
So our two growth funds would be our development funds. One is Growth Fund 4 and the other is our QOZ funds. So the difference there is a Qualified Opportunity Zone Fund. I call it QOZ. You need capital gains in order to have all the tax benefits. So simply put, if you're interested in growth, and growth I would define as you're targeting, 14 to 18% returns, but you're not going to get cash flow in years 0 through 4, because that's the development period. We're building, then we're leasing, stabilizing, creating cash flow. So it's a choice. You're getting a higher expected value, but you're having to wait. You're not getting dividends in year 1, 2, 3, and 4. We've done quite well in our development. I'm quoting 14 to 18, but our returns have been significantly higher than that on things we've done to date. That's a growth investment. And again, if you have capital gains, it's the same strategy, the same target return. You're going to get an additional 30 to 50%. And I'm trying to understate this boost to your return based on all these tax savings and deferrals. Some quote it significantly higher than that. So I always advise a client, if you want to be in growth and development and you have capital gains, it's a very easy decision. You go into QOZ. A lot of our clients don't have capital gains. And so at that point, if you want development and growth exposure, Growth Fund 4 would be the place to do that. Income Plus is interesting because it provides growth and income. And it won't be surprising to you. It's because it has investments that are stabilized assets that produce cash flow. Interesting enough, once you have an asset, a private asset, you can depreciate it. And that provides a lot of tax sheltering to that fund, which is you can't do when you're developing. You can't depreciate an asset until it's built. That should make sense. But then it also has preferred equity investments. Most of those, in fact, right now, all of those, this is another question, is, are your preferred equity investments accrual or current pay? Right now, they're all accrual. That's why we're getting, 14 or even higher percent returns on those types of investments. And then if you really want just high yield current income solely, that's multifamily credit, which is both our safest fund, but also our highest yielding fund in terms of dividends. And the reason for that is it's buying credit positions or originating credit positions. If we're talking about our next multifamily credit fund, which we should talk about, Michael, a little bit on the call. But that's, that is an example of income straight down the fairway. You're talking about 7 to 10% returns, but it's paid monthly. So there's no right or wrong to growth and income. It's really more about what fits your needs and your portfolio. I weighted pretty heavily into multifamily credit as an individual recently because I like the safety, but I also like the current yield, and I was very heavily weighted to growth. So I wanted to sort of balance it.
Yeah, and just to add on to that, the way our funds have been set up, it's a risk return perspective. So you have low risk on yield, which is multifamily credit fund. You have moderate risk, which is yield and appreciation, which is our income plus fund. And then you have Growth Fund 4, which is for people who want to generate a higher multiple and don't have a need for income in those funds. And that's how we think about our suite of products. And then QZ is the Special Opportunities Fund. The next question is related to an article that I actually wrote. It says, in the recent stress testing article, cap rates of 4.5 and 4.75 were used. In a severe recession, why not cap rates of 5 to 6? Good question. I would say this, that the purpose of a stress test is to show where we begin to lose money, how we lose money. And that was the purpose of that article. And anybody who hasn't read that, I implore you, it's an article that I spent a lot of time on, worked with Mark Turner in investment management to really look at each and every asset in the part of the portfolio, stress testing it, understanding, we don't know the future, but if 2023 is a really bad year for real estate and something happens, how do we lose money? And that's what that article was about. 2023 might be a great year, and none of this might be, but risk management is all about looking at downside, and then you let the upside take care of itself. You have to understand, though, that in that scenario, I was reducing rents by $200 per month and increasing cap rates significantly. The reason why I use 4.5% cap rates is that's where we believe the current market is today, right around there. In some of the growth markets we're in, they're probably lower in places like Dallas, places like Nashville, places like Austin, Tampa. But that was sort of the midpoint. And the question about why not cap rates of 5 to 6, because the way the world works is there's an interrelationship between borrowing costs, interest rates, cap rates. And if we are talking about a severe recession, there's never been a recession in the history of the United States where the 10-year has not come down by at least 150 basis points. And so if you use that 4.3% that the 10-year hit about a month and a half ago as the high, that would put the 10-year at 2.8%. So if we do have a reduction in rental rates, in income at the property level, chances are cap rates aren't going to go to 5 or 6. They're probably going to come back down to 3.75 or 4, because they are in some ways related to the 10-year, because borrowing costs are also related. So what's really putting the market in flux today is you've had a rise in the 10-year, which has impacted borrowing costs. Borrowing costs are, today probably around 5%. So there's negative carry in the market, which has sort of halted the market. And we've actually had a really good day in the 10-year. I think it's around just below 3.6 right now. So 70 basis points off the high and quietly coming down. And the last thing I'll add just to this is I actually wanted to understand what happens in an inflationary environment, in war times, in pandemics. And I went kind of into a rabbit hole and did some research. And you can actually go back 1,000 years because there's data on this stuff. And generally what happens is these last 2 to 3 to 4 years at the most, and then inflation goes back to normal, sort of that 1.5 to 2%. There's a saying, don't fight the Fed. The Fed is set on killing inflation, and they will do it. We can hope that there's a soft landing. There is an inversion to the yield curve right now. I believe that that's going to hold true, that the Fed is going to win this battle. Inflation is going to come down. The 10-year is going to come down. That this moment in time where you see this disruption, markets will normalize going forward. And so that's what we have to think about when you're kind of in it at this moment in time. The nice thing is we don't have to sell anything, and we have plenty of capital to ride through the storm. Next question, Dave, is for you. Will exits from CRE continue as usual or be delayed or speed up based on Fed Reserve's move up in interest rates during 2023?
I think the question is, if you want to sell assets, you can sell them. Is that how you're interpreting that?
Yeah, it's I think it's velocity, just kind of transaction volume, within the general market based on what the Fed is doing. So it's kind of a crystal ball question about 2023.
Yeah, I actually think volume will remain not as robust in 2023. I think that there's still a disconnect between buyers and sellers on pricing. Also, lenders are, kind of leading here. I mean, the Fed, don't fight the Fed is right. But what the Fed really has done is influence bank behavior, which is a good thing, actually, because the multiplier of money is way down. So as banks are lending less and increasing lending standards, that's actually reducing the supply of money in the economy. So they're helping the Fed do its job. I'll go further. A lot of predictive elements of inflation have come down. I mean, lumber is 400 a board foot right now. It was 1,500 a board foot a year ago today. And so, like, think about that. It was 300 a board foot forever. Then it went to 1,500. Then it went to 800. Then it went to 1,500 again. It's 400, right? You and I were talking about this yesterday, but shipping containers, like, this is something we all should be watching. You know, it was 10, 20,000, and now it's back down to 3, per crate. That's crazy. You're not talking about small moves here. I mean, it's down 4 to 5x from the high. So I do think that we're heading in the right direction on a lot of elements of inflation. The part that is sticky, and I'll plug another thing we're doing here because I'm kind of getting into it. Every year we do, and in the past, it's just been an article on our predictions for the following year. We've done it for the last 3 years. And then in the subsequent year, we write 2 articles. One is a grading of our predictions, like how did we do? So obviously a year later, reality happened. And then we make new predictions. This year, we're going to do a webinar as well and bring on a lot of our team members. But I can tell you last year, so end of 2021, when all the assets, were on their high and the Fed was still saying that, inflation is transitory and they were actually still stimulating the economy. We made a lot of predictions that were very prescient. And more importantly, we didn't just write it, we did something about it, right? So if you look at what we talked about last year in the article, we cited inflation as not transitory and a real issue that needs to be dealt with, and also that interest rates were going to go higher. We were right about all of that. And more importantly, we hedged our interest rates, right? So writing about something's nice and doing something about it is better. And you as investors, by the way, you're up significantly in all of your funds because of these interest rate hedges. This is not, we talked about this on our last webinar, but this is, $40 to $50 million of profits that are allocated pro rata to different funds via the hedges. It's not nothing. If you think about, we run about $1.2 billion in equity right now. That's a 4% return across the funds just from the hedges. I mean, that's a lot of money. So we're really proud that we didn't just write about it. We did something about it. But as we sit today, the question was about volume. Luckily, Origin doesn't need to do anything. Michael spoke to this, but all the assets we needed to sell were really in Fund 3, and we did it, right? I mean, we sold a tremendous amount of assets last year. The funds that we have now are long dated funds. Income Plus owns real estate for long periods of time to be tax efficient. QZ, long dated, right? So we're not veering from strategy. We did the things we needed to do with the funds that needed to sell assets. If I was in a position and Michael was in a position where we had to sell a lot of assets in the next 1 to 3 quarters, to me, it's very unclear what next year will look like because of the buyer-seller discrepancy and also the lending environment, neither of which I can predict.
Next question is about QZ Fund 2. How has it progressed compared to expectation when the fund was launched a year ago? So very different market a year ago. And I can say that 10 years is a long window to be able to predict something. So our kind of our outlook for the 10 years hasn't changed much, even though the market has changed. We're in phenomenal cities. We have great projects. That fund will be invested much faster than Fund 1 because our pipeline going into it. And I can also tell you that if we were delivering projects today, that there wouldn't be much in terms of refinancing proceeds, if any at all, because of the how upside down and the negative carry in the market and where lenders are. So the near-term outlook maybe isn't as favorable. But what you also have to understand is we are going on the webinars and reporting out on this stuff, and we're trying to give everybody an accurate estimate of what those refinancing proceeds are going to look like out through 2026, because it's it's the source for many people to pay their taxes. And that has been revised downwards quite a bit. And that shouldn't be a surprise when your borrowing costs go from, kind of 3.25% to 3.5%, all the way to 5.5%, and the lending market pulls back significantly. It used to be that you could take 50, 60, 70% of your equity out at a refinance. And today the market is so upside down that even projects that are being delivered right now, the banks are actually requiring a pay down of their loan in new refinancing scenarios. So that can change very quickly. The nice thing about having a 10-year window is that multifamily real estate, it's never lost money over a 10-year period, institutional quality, and that's what we're in. Now, we're not here not to lose money. We're here to make money, and we will continue to update that fund on a regular basis and send that out to you. But it's still very positive for fun, happy with the investments and the markets we're in. Dave, next question is, what markets that Origin operates in are experiencing potential overbuilding of multifamily units? Is this impacting any of our plans?
Certain markets in the short term, I would make the distinction here. So like you take a city like Austin or Nashville, there's a lot of deliveries in the next year. And so people can focus there. And you're always, how do I say this? Supply is defined. We know how much supply is coming to a market. In fact, that's a big component of multilytics, is it's getting all that information about supply, and not just a city, but a submarket and an address level. But what isn't defined is how many people are moving to a city, right? So like on the one side, we've made this mistake, Michael. You remember this when we were in Nashville, and it was 10 years ago. And we said, oh my God, there's so much supply coming to the market. And at the time, they didn't even have a lot of housing stock. Like there weren't a lot of apartments downtown at all. And we said, so no, it wasn't just a lot of supply, but it was sort of like saying they only have 40,000 units and they're building 5. It's 12% of new supply, right? And so what happened instead was more people moved by 150% than expected, and you actually had an undersupply, even though you thought you'd have an oversupply. So what I'm trying to tell you is, supply is defined, demand is created through people moving, both for work, lifestyle, et cetera. And in our cities, that is what's happening. And yes, we do it with data. But I also, I would encourage you, because I do this too, just talk to people. How many people do you know in your network that are going to move to Nashville or Austin, since I'm talking about those two, but we're in Denver too, Phoenix too, Tampa Bay too. I mean, these are the cities, Charlotte. That's where they're moving. And a lot of them move there without a job. They just say, yeah, I just want to live there. And, you don't hear that about Cleveland. You don't move to Cleveland without a job and say, I just want to live. It just doesn't happen. And so I hate, if you're a Cleveland resident, sorry. But, I could say the same thing about a lot of cities. The next point I want to make is the questions about short-term supply. I can tell you the other thing that's happening, and Michael already sort of alluded to this. The supply today is very, very different than what will happen in a year, 2 years, 3 years. And what's going to happen is we already have a housing shortage, in particular a housing shortage in these markets. That's where it's most acute, because that's where the people are moving and need housing, whether it's rental or for sale. In both instances, home builders have pulled back in a huge way. They're not building as much. And now multifamily developers have pulled back in a huge way for all the reasons Michael mentioned. More difficult to get financing, more difficult to get money out at refi. The numbers just don't work as well. Some of the deals do, like the deals that we're getting done, they're still 30 to 35 margin. They make sense, you do them, but it's much harder to find. My point is, the housing shortage we have is about to get worse, a lot worse, because there's going to be a 12-month period where not much gets done. There's not going to be a lot of activity. And what you're going to wind up with in 2 or 3 or 4 years is a landlord market. you're going to be happy you own multi, because the people will keep coming, but the deliveries won't be there, right? So like let's make a distinction of focusing on the pipeline of things that will get built, and then the next extent out. And by the way, again, that's what Multilytics is predicting, right? Negative rent, largely caused by short-term disruptions and oversupply, but then the fundamentals kick in, and they're much, much stronger, and they'll be exacerbated by a lack of supply.
Yeah, it's such a good example of how the world has changed. When we were looking at multifamily 3, 4, 5 years ago, we used to draw a 1 mile ring, a 3 mile ring, and you assume your demand segment is within there. Now that ring is 1,000 miles, because there's so much just population migration going from the northern cities to the southern cities. It's still happening today, and it's changed it. And thank goodness for multifamily or Origin Multilytics to measure that demand, because that is more amorphous than supply. The next question is, how does multifamily credit fund react as interest rates move up and move down? So 70% of that fund is actually floating rate debt. So as the interest rates have moved up, that fund has benefited substantially. Same would happen if it moved down. You would actually see a decline in yield. That is an incredibly well protected fund. And candidly, if I had more capital and more liquidity to invest in real estate and in credit right now, that's where I would be putting my money. Because I just think, like, there's not a lot of places today where you can generate 8.5, even 9% yields on your capital in a very well protected position. Dave, next question is for you. Do you see great opportunities to buy properties at discounted pricing in the near future?
So for the folks that are on a lot, you're going to recognize this statement. But to me, the world's probability, right? It's a series of potential outcomes. We plan for all of them. That's what risk management is. I see a probability of there being interesting buying opportunities in Q3, Q4 next year. I don't think it'll happen in Q1 and Q2, but there's conditions that need to exist for that to happen. So the conditions would be inflation stays on the higher end longer than we think, interest rates stay elevated longer than we think, the Fed doesn't pivot so that short-term rates are still about where they are now, or even up to 5% as the curve predicts it being. If those things happen, there were a lot of deals that happened in 2021 at irrational pricing. That's, by the way, why Origin never bought a deal. We haven't bought a deal in 2.5 years. And back to risk management, these are decisions made. You don't get to unmake them. If you bought a 3.25 cap or 3.4 cap, or whatever you did last year, that's risk management. Like, you overpaid. That's not good. And then a lot of these deals happened through financing that was short-term in nature and variable in debt. So that you were at the time, LIBOR, it's now SOFR, is 0, and they're borrowing at 2.5 to 3%, because they're only paying the spread over a 0 SOFR. But now, if SOFR goes to 5, they might have 7.5, 8% debt, but they bought a 3.5 cap. That means the 3.5 yield. And yes, they got rent growth. So maybe the 3.5 became a 4.25 through rent growth, but they still have 350 basis points of negative carry. And importantly, they need to refi, because it was short-term in nature. It might have been 2 or 3 year debt funds. If all those things happen, right, and then you layer on flat negative rent growth, which is what Multilytics is predicting, I see a scenario where there's going to be distress, and it's a huge opportunity for Origin. Number one, our funds are incredibly defensively positioned. So like Michael said in his article, and I also covered this on a webinar, it's important for us to understand how insulated we are at Origin. Like, as a manager, we have to be able to tell you, these are the conditions by which we would start to take a loss. Because if you can't do that, you either don't know what you're doing or you're lying. Both are bad, right? And that's why we're being very transparent. And we know exactly when it would happen and the conditions it would be in. And we're very protected, but we're going to be able to play offense if this happens. And I think there's a real probability it will. I'm not saying certain, but it could. There are certainly the transactions that would support this type of move. If that happens, we will be in the best opportunity to make the best returns we have. I mean, if you look at the history of Origin, we were built out of the Great Recession. Our first 25 deals at Origin were bankruptcies, restructures, foreclosures, discounted payoffs. I mean, it was that entire ecosystem. We thrive in it. That said, that's just one outcome. I don't know if you want to add to that, Michael. My point is I'm not certain about it, but I know we're positioned well for it. And if it goes there, we're able to thrive in that environment.
Yeah, the only thing I'm going to add, Dave, is this, that it's a great question. And I like that they said the near future, because it's hard to see out a year, 2 years or something from that. What I can tell you right now is that there is a tremendous opportunity, and I alluded to this before, in the credit market. And we're already seeing sort of cracks in the foundation in the lending market where properties are coming, they're trying to get refinanced, over leveraged properties. There's an enormous need for gap equity. And a year ago, the terms were essentially 11.5%, and you'd have to lend to 85%. Today, the pendulum has swung the other way, where now you can generate yields in gap equity, preferred equity, right, where you're coming in and helping them bridge the capital structure. You can generate yields of 14% and go up to kind of 75%, maybe 80% at the most, but 75% that accrues to 80%. So you're actually in a lower risk position today and generating a higher yield. And that's where the opportunity is because of what's happening on the interest rate side. And there's two things, and why I want to mention this is because we're coming out with a promotion today because we want to raise as much capital as we can possibly raise in the Income Plus Fund to take advantage of what we see as a temporary dislocation. So look for that email. It's basically, we're waiving admin fees for anybody who comes into that fund between now and December 31st. And then on top of that, there is a sidecar that we're going to be offering only to fund investors. So you have to be in the fund to get access to the sidecar. That's going to be offered in January. So we've got about 3 or 4 deals. They're all preferred equity, well-protected positions. And I think that's something that you are going to really want to take a look at, and like if you have an appetite to invest in the credit side in real estate and generate those returns, will probably come out between like 10 and 11% on those. Dave, the next
Michael,
question
is. I have a.
Oh yeah, go ahead.
Go ahead. I'll answer a question because I actually looked in the Q&A. Someone asked if I'm in Qatar, in a car, and it rhymes too. I am in a car. I'm not in Qatar. I am. Is it Qatar or Qatar? I always mess that up.
Yeah, pick them. Yeah.
Anyway, I'm in Orlando, so probably similar weather. It's 75 here, but that's a market we cover. If some of you are in our QOZ1 fund, we have an asset there. Fund 3 had a very successful exit on an asset there as well. So we're pretty active in Orlando. But go ahead.
What kind of rent-a-car are you in, Dave? Let's just start with the important stuff. What'd you get?
Well, it's too long of a story, but I got treated badly, and then they felt bad, and they wound up giving me a Mustang convertible at a nice low price. So that's the answer. All
right, cruising around. It's good. Yeah, well, good car for the warm weather in Florida. I'm jealous. Let's take this next one. At what point will the Income Plus Fund close to new investors? The Income Plus Fund is an evergreen fund, meaning it goes on forever. There is no cap on that fund, and candidly, we could put another 0. The net asset value of that fund is $330 million, and we can run that fund as a multi-billion-dollar fund. I'm not saying that we could take $1 billion today, and I think that's the other question: is how much money could we put to work in that fund and still maintain our return objectives? A lot. And when you think about that particular fund to build, buy, and lend, the building is the ground up development portion of that fund is limited to 20%. And that is a build to core strategy, because what David talked about, we haven't bought a new deal in 2.5 years. And so everything we've been doing is building to core to protect basis, because we've been building at $300,000 a unit while the market's trading at $400,000. So rather than buying at 400, because that's a sleeve, we'd rather build and then put it in that sleeve and protect our basis that way. Then that ground up development portion gets new equity is allocated towards new ground up development. And that continually is sort of the what I call the jet fuel for the returns on that fund, because the ground up developments, those should generate IRRs in, kind of a 3-year period, close to 20%. And then you have preferred equity on the other side. That is always going to be, 30, 35, 40% of the fund. So even as we become a multi-billion-dollar fund, those sleeves will be, will have plenty of ability to continue to generate the returns and find enough. But I will say that if the market does slow down, we're always reevaluating these things. But as I sit here today, I just don't see that there's any sort of even near-term risk of us closing that fund to new investors. We're taking capital today, we're putting it to use. There's more deals out there than capital that we could invest today. So it's a great market for that particular fund. Dave, let's see here. Interest rates might stay higher for longer. Could the income plus portfolio withstand 6% cap rates? This goes back to that stress test comment. You there?
Sorry, I'm muted. I'm muted. So you pointed out earlier, you have to also take in consideration rents. And so if the question is about cap rates at 6%, in a world where we're growing rents, rents are up historically 2.5%, 3%. Our income plus fund, it's probably flat for the year in that world, right? The pref is still going to work, but it's becoming at a 6% cap rate. If you think about that, that was underwritten at a 4. So now you're talking about, a 50% move up in cap rates. That's a pretty big shock to your multiple. There you're going from, if you think about a cap rate, a 4 cap rate is a 25 multiple on earnings, and a 6 cap rate is a 16. I mean, that's what's happening. So you're going to need a lot more earnings, right? But that's my short answer is, at that point, we're not making money, and we're having to really work hard on our pref, because it's getting to the point where that's sort of our break even is 6, unless there's rent growth, and then that builds in more cushion. If there was also rent contraction along with a 6% cap rate, that's where it gets very difficult, because now your multiple is going from 25 down to 16, but also your EBITDA or your NOI is lower. And so you're multiplying a lower multiple on a lower number. So obviously the net of that is much lower. So look, I said this before, if the question is there a world where Origin can lose money on its funds? The answer is yes, right? Like, of course there is. If we go to a place where cap rates are 8 and rents go down 10%, you will lose money. And you know what else will happen in that world? You'll lose 10 to 20% in that world here, and you'll be down 80% in the stock market. Like you have to kind of keep this in perspective of other assets. What happened this year? Stocks are kind of down 15 to 25% based on what types of stocks you're in. Indexes, income plus is up 8% at this point. Last year it was up 20%. It's not immune to a correction. It could happen, but I think that you're going to sleep a lot better here than a lot of other investments you have. I'll just say that.
Yeah, and I think there's always the relationship, and the question is, why did cap rates go to 6%? And there's a few reasons. Number one, you can have the 10-year that explodes and you have an inflationary environment and real estate benefits from that. And to your point, Dave, you grow your way out of it with higher income. But if it's credit related and you're looking at something where there's distress and you're getting lower rents, but you're also getting the 10-year treasury blowing out because the US credit goes into default, like this has happened in other countries, then yes, all bets are off. So that question, like, it's always easy to isolate one variable, but it's a complex world we live in, and there are so many things that go together to valuing assets. And to Dave's point, yes, there's always a stress test in which we lose money. That was the point of that article, to show you where that happens. And you are going to have to make that decision. Is that realistic? Do I think the world is going to go worse than this and become worse than this? Or am I comfortable with this level of risk given where we are today relative to the other investment choices I have, which are just sitting in cash? Next question here. The returns were highest in Origin Fund 1, somewhat lower in Fund 2, and somewhat lower in Fund 3. Will it continue lower? The answer to that is no, and you have to look at the vintage because that matters, and you also have to look at the returns relative to what other managers were doing. So in the case of Fund 1, we were top decile. Fund 2, we were top decile. Fund 3, we were actually top quartile. But each one of those vintages, I will tell you that the investment strategy didn't change much. We as a company evolved. I think we've gotten a lot better. When we were investing Fund 1, we were a team of 8 or 9 people. Today, we have 50 people at the firm, and we're a much more robust organization. But certainly, if you were investing in 2011, 12, and 13, you can expect to make more money than 2018, because the values back then, they were trading at 40 cents, from a replacement cost value, and that's what matters. And when you start bumping up into the replacement cost, a lot of times that is going to be your governor on returns. Things can only go so far above replacement costs, as we've seen in COVID, before new supply comes in and reduces that gap significantly. So will it, we're going to generate the best returns we possibly can, but we're also subject to the environment somewhat as well. So I think the Income Plus Fund has done very well over the last couple of years. Multifamily Credit Fund for a credit fund has done well. You're going to see QOZ has done well. And then Growth Fund 4, we haven't yet floated that share price yet. But for this vintage and this opportunity, I believe all those funds will be in the top quartile, if not the top decile. Dave, you want to take any from the Q&A? You want me to read them to you? Are you in a place where you can read them?
No, you can read them.
Okay. Let's see here. Think of the fund of Freddie Mac, Fannie Mae securities. Why should we not just wait for the next such fund given rates? This is from Henry. Thank you, Henry. It's for you, Dave.
Yeah. Look, we've done an amazing job in that fund of putting together a portfolio that's yielding what the market's yielding now. And that's because we did, to Michael's point, 70% is floating. So the stuff that we were doing at 600, 700, 800 over when it was a zero SOFR, you can add 400 to that now, and it might be 500 if they raise again. So there's no real advantage to waiting. So this notion that like you're going to get better pricing because I waited, you won't, unless, by the way, the spreads keep going out. Right now they're not. They're actually flat. The last auction they came in a little bit, but no one can predict the future, right? I don't know where spreads are going to be in January, February, March of next year. I can only tell you that today, I can't do better for you than the fund that exists today. And the yield is real. If you buy into the fund, you get the yield that next day. If you come into Fund 2, you'll have to wait for us to build that portfolio in order to provide the yield, right? It doesn't just show up day one. We've got to, raising money is only part of the challenge. We also have to find the investments that suit our criteria and convince people who own those investments, who are issuing them, to sell them to us at that pricing, right? It's a complicated process. So that would be my answer for that.
All right, Dave, we're at the top of the hour here, almost out of time. So let's do some speed rounds. We'll answer these quickly. I'm going to take 2 questions in a row. You've mentioned preferred equity several times, but you can please define that for me. Yes, this is from William. William, preferred equity in the capital structure, you have senior debt that generally occupies from 0 to 65%. When you're buying a deal, let's call it $100 million. So they will fund $65 million. Preferred equity will sit just above that. So typically it'll occupy the part of the capital structure, 65 to about $80 million. And then you have true equity above that. Much of what we're doing is in ground up development. So you also have to consider the profit margin on top of that, which is part of the equity. So we're looking at both a loan to cost and a loan to value. So thank you for your question. Should have clarified that. Next question is from Bradley. What is the tax profile of Income Plus Fund? It's incredibly tax efficient. Bradley, 95% of distributions last year were tax-free. That fund is designed to be tax-free. First and foremost, we're looking to generate investment returns. So it is tilted towards preferred equity today more than common equity. So it's going to be a little less tax efficient, but that is one of the goals of that fund. Dave, do you have questions in front of you or do you want me to read these still?
No, you got to read them.
Okay. Can you give us some details on how the sidecar is going to work? Would this be a good fit for an RIA as no tax advantages? So from Steve.
Details of the sidecar. I mean, it's going to be all accrual preferred equity. That's a huge opportunity in the market right now. Again, to just give you an idea of how different it is, in 2021, senior lenders were lending generally to 70%. So if you wanted to be in preferred equity, you would occupy in the capital structure 70 to 85%. Some went as high as 90. We never did, but some did. Meaning at 90, you only have 10% common as first loss, right? In 2022, lenders are lending to 55 to 57%. So we get to occupy, let's say, 57 to 75. Again, last year it was 70 to 85. And I've written articles on this personally. There's a mathematical formula of the required return on equity relative to your position in the capital structure. You can do the math. It's exponential. Like, in other words, you need to get a lot more return than you think when you move up the capital structure. Go into our education section if you're interested in reading that. You'd probably be the only one who ever read it if you did. But anyway, the point is we're way down in the capital structure from last year, but we're getting 20% more return. So last year, the market, was right around 11.5% for that unit of risk. Again, the risk-free rate was 0 at the time. Now we're getting 14 to 14.5%. So taking a lot less risk on more stringent underwriting, assuming much lower starting rents, negative rent growth next year, all the things I talked about, but also getting 14%. We like that a lot. And so the reason we're offering a sidecar is, and I've seen this many times now. It actually happened in 2018 for a brief period. It happened in the first 6 months of COVID. These are short-term opportunities where senior lenders retrench, and we have a tremendous amount of deal opportunity, and then they close. My guess is in 6 months, we'll be sitting here kicking ourselves that we didn't do 3 or 4 times more the volume that we did. That has been the experience that I've seen. So that's what the sidecar will be. I can't tell you the size of the sidecar because we have a tremendous amount of deals in the pipeline. But number one, they have to clear our own criteria. And for example, I'm doing this morning. Dave Welk, who has been with us 11 years, managing director, runs our Charlotte office. He has a very interesting deal in Atlanta. And we're spending a lot of time at credit committee on that deal. And there's, it's an $18 million pref piece, and there's a lot of things we really like about it. But we're going to spend weeks and weeks uncovering every rock before we make an investment like that. But I could say that about 5 other deals, right? So we don't know the size. We do know that there's an opportunity, and that's the reason for the sidecar. In terms of taxes, Michael, when he talks about being an REA and taxes, I'll defer to you on that. I mean, that's really more the capital raising side. I'm on the deal team.
Yeah, IRA. Steve, just reach out to somebody in investor relations and we'll get that answered for you. So I don't have that off the tip of my tongue because we're not sure how that's going to be structured right now. And Dave, you already answered Henry's question about adjusting leverage in the face of what is happening. Aaron asked the question, what factors make buying existing multifamily attractive to you again? Aaron, that's a pretty easy answer there. There's two things. Number one, yes, it's got to be trading at or near, at or below replacement costs. And the other thing is just seeing positive carry in the market. It doesn't make sense right now when you're buying a 4.5 cap, if you're even buying it there, if the market's trading, transactions have sort of come to a halt, and then borrowing at 5%. Leverage is supposed to be positive and accretive, and every time you get a correction, it does fall back. You can always identify a recession because everybody is only forecasting growth ahead, and then you have negative carry, so leverage actually doesn't help when you put it on. And then in the trenches, growth goes away completely, and everybody's looking at levered yield. And in order to get that, you need positive carry, meaning borrowing costs are below cap rates. And so we're going to look for those two things in tandem before we start buying assets again, and we hope that happens. What percent of the Income Plus Fund preferred equity is current pay versus accrual? So of that portion of the fund, about 64% of the Income Plus Fund's capital is in accrual preferred equity, right? Very little of that. Some of it converts to current pay once those projects are done, but nearly all of it, I want to say 95%, is in accrual preferred equity. Dave, this one I'll give to you. I've heard you mention using interest rate swaptions in other webinars. Can you explain how those work? An example of one we have used. This is from Jeffrey.
Yeah, thanks for the question, Jeffrey. So before I talk about swaptions, you have to understand a swap. So a swap is when you swap one type of debt for another. In our case, we would be swapping, and it's always done with the bank that issued the debt. So on a construction loan, we're borrowing variable rate debt priced over SOFR at this point. And we would be swapping that for a fixed rate from the bank. And we do that when we can. We've done quite a few swaps. The problem is, if you have developments that you've approved and you're in pre-development, which we have for QOZ1, QOZ2, Growth Fund 4, even Income Plus does that 20% development sleeve of build-to-core. If you haven't broken ground and borrowed, you can't do a swap. You can't swap debt you don't have, right? Because the debt itself is the collateral. So in that case, you can buy a swaption. A swaption is an option to convert to a swap at a future date at a pre-agreed upon rate. And so that's what we did in a lot of these funds, because we didn't just want to hedge the deals we'd broken ground on. We wanted to hedge the deals that we had approved and knew that we would need debt on at some point. And so that's why our interest rate strategy is a combination of swaps and swaptions. If that's not clear, I'm happy to talk to you offline. I know it can be a little confusing. My first career, and Michael's, this is kind of interesting, was derivative trading, both of us. And so in an interesting way, swaps and swaptions are full circle for us. It's a way to hedge real estate, but it's a derivative. And we have a lot of experience in that.
Phil asked a few questions. Phil, we're not going to have enough time to get to these, but I implore you to reach out to us because these are too lengthy for me to even read here and get this to you. My email is michael@origininvestments.com. You can email me and we can talk offline and I'll get you this information and we can chat about real estate. I always love that. Jordan asked, how much longer will Growth Fund 4 be open for new investment? Jordan, we are raising capital in that fund through the first quarter, at least to my knowledge. I believe that it's 1 year from the first capital call, which was April 1st of 2022. So that'll be open till March 31st. We'll be raising new capital in that fund. Thank you for your question. I already got the one about is Dave in Qatar. So where's the Ogana asked, can you send me the link to the article? Ogana, the easiest way is just to go to our website, origininvestments.com, go to education, you'll see the article, kind of the top ones. We have an article about the Income Plus, about valuation, our valuation policies, everything else, and hundreds of other articles that you can access there. Let's see here. Phil, you have a lot of great questions here, so I look forward to speaking with you offline. And let's see. Tom Brooks asked, sorry, I'm not, try not to use last names. Why do you need a sidecar?
You want me to answer that?
Yeah, Dave.
Yeah, sidecars are used almost exclusively to make sure that the funds are diversified. And so, if we have a deal that's too large for a fund, meaning if a fund wants to have 10 assets, it's a $300 million fund, you kind of want to have each asset be about 30 million. Well, what if one of the assets is 60 million? We don't want overexposure in the fund, so that we provide that co-investment opportunity, typically to those fund investors who will fill that. Historically, that's how it's worked.
Great. A lot of these are last one, Dave. I'll take this, and then you can sign us off. How do you view yesterday's news that the trajectory of Fed rate increases may slow? It's positive, and this is from Michael. Everything about what the Fed has been doing, I think they've really done a good job of kind of communicating. But from the real world, Dave mentioned this. You just got to pick your head up, and what they're doing is working. The job numbers this week, the ADP payroll numbers were a little less robust than they thought. So we're seeing a small cool down in the job market. Lumber prices are down, construction prices are down, realtors are sitting on their hands, housing starts are slowing. The Fed it's working, and they will continue to moderate. It doesn't mean they're not going to raise rates in the future, but I think what they've done so far, they've sort of put their foot on the brake, and we're going to get to the other side. And I do believe that we're going to see inflation get to 2%. I would never bet against the Fed in this environment. So it's positive, especially if they can manage a soft landing. We'll see about that. And I think that the short end of the interest rate curve is going to remain high for some time until they really see things, I think, cool off. So I'm hopeful that we do see a soft landing, and I only view that as positive news. And clearly the stock market reacted in that way as well. So thank you for your question, Michael.
You want me to sign us off?
Sign us off, buddy. That's it.
All right. Well, thanks for leading and asking all the questions. I thought today was really productive. Great questions. I know we had 26 live questions and about 50 sent prior. We tried to group it into themes, and I think we covered everything that was asked. If you don't feel like it was, it's just our name, Michael at Origin Investments, David at Origin Investments. Send us a email and we can answer them, or send you to the team member. We have 50 team members who can also help. Because candidly, if your question is about something really legal, I would refer you to our general counsel, who will answer the question better than me, right? It's not always me that has the best information. In terms of the format here, love to hear your feedback. This is our second Ask Origin webinar. I really like it. I like the Q&A feature of all of our normal webinars, and that was the idea, is just expand on it. But as in anything, let us know how we can improve it. Or if you're enjoying it, let us know about the cadence. If you'd like to do it quarterly or monthly, you will see by our actions, not our words, that we're committed to the things we talk about. We're committed to transparency. That's why we're here, right? That's why we do so many webinars. That's why we answer the hard questions. We're committed to be aligned with you. That's why we're the largest investors at Origin. So, follow our deeds, not our words. Anyone can talk. Michael and I talk about this a lot. If you go to any company website, they probably list the 5 different values, and it generally makes me want to throw up. So that's kind of my mantra, is don't be the firm that makes you want to throw up. like actually live the way that you are talking about living, like through your actions. Thank you for your time. I will hopefully talk to you everyone very soon. I appreciate the questions.
Thank you, everybody.